Okay, so we want to welcome you to the second episode of Portfolio 123's Superstar Interview. Sorry. I'm really stoked that we get to interview you. I follow you on X, Twitter, or whatever Elon's calling it these days. What I like is you always have something super interesting to say, and you also invest in markets that everyone hates, like the TSX Venture Exchange, and you make it work somehow. So that's super interesting. So welcome to the show.
Excellent. Thank you. So glad to be here. Thanks for the invitation.
We also have Andreas. Would you like to introduce yourself as Portfolio 123's newest team member?
Yes. Yeah, we can make it official. I'm using Portfolio 123 since 2011. I was in a IT industry for 20 years, and then 2020, I went full-time as a trader. And I don't know, 4 weeks ago, we decided that I can join the team of Portfolio 123. So I'm the sidekick today.
Oh, nice.
Right.
Okay, so Ryan, before we get into some of the strategies and that, we'd just love to hear a little bit of a background. What do you do for your day job? Just tell us a little bit about you.
Sure. Yeah. Actually come from a non-finance background. I'm actually an engineer. That's my current day job. I'm a project manager at a mineral processing consulting firm based in Canada. So I've been doing that for some time. And I also invest kind of on the side in my spare time. Yeah, I'm also a husband, a dad. I have a pug. That's my investing sidekick.
So you got loads.
That's right.
Yeah, you got loads of free time. Then I see.
Yeah. So investing. I kind of discovered quantitative investing through a series of other events. I mean, I did the Buffett path. I read all of his books, or all the books on Buffett, rather. I tried discretionary investing, tried real estate, and then even had a stint in quantitative investing to start off well. That's some good beginner's luck. But then that kind of fizzled. So I got kind of started on some other path and say, hey, let's give this a shot. Let's try it again. So I came back, and I guess in my current kind of strategy and approach, I've been at it for about 5 years.
Okay. And you work in a mining field, so that means you do exclusively gold and silver stocks, I'm guessing?
Actually, I actually don't. I don't really do what Peter Lynch suggests. I think that's the beauty of being a quant investor, is that, or any investor really. Like, I mean, you've got all these companies in the markets that may not be your background, but may actually be better businesses than maybe what you know. So there's definitely lots of opportunity out there. But to go back to your initial question, Curtis, actually some of the strategies are picking up some mining stocks right now. So that's, I mean, we can get into that later, but yes, interesting.
Yeah, DM me after the show's over. Let's not talk about it now. I want to get in first. So,
Good.
How you come up with an idea? Like, well, where does it start?
Sure. I mean, I guess different ways. Of course, if I go back to basics, Greenblatt's magic formula, the little book that beats the market, absolutely necessary reading for any quant, really. It's basically a quantitative strategy for finding cheap stocks that are high quality. And it's a simple ranking system. You're ranking on those two factors. You're buying the top 30 ranked stocks, rebalancing annually, and then you go from there. I mean, that's two simple factors. Greenblatt had amazing success with it. It's not as powerful a strategy these days, really, but definitely, I mean, it's just a springboard to all kinds of different other strategies. I mean, where do I get ideas? Definitely, yeah, reading books, going through academic papers.
Okay.
Sometimes it's fun hearing some of the conventional wisdom, saying, "Oh yeah, cyclical stocks, they were bad investment." But sometimes it's fun to go to those stocks and try and really test out, okay, are these good investments? Do they work? And you might find the results are the opposite of what conventional wisdom says, and then you dig into it where the market isn't looking, and then that all of a sudden becomes a strategy and could provide some alpha. Right. So that's always fun. And then of course on Twitter, you hear quotes all the time from quotes and experts on how investing works. And sometimes it's fun just to test those statements, and you find they're actually not true whatsoever.
Yeah, absolutely. You ever bounce ideas off like your kids or your spouse? Because what I find sometimes I'll be talking to my wife, she has an idea and I'm like, well, what do you know? You don't know anything. I test it and I'm like, actually, that's a pretty good idea.
Yeah. It's I know what you mean. Yeah, you might, or at work, someone might be talking with something in the coffee room, absolutely unrelated to investing. Then that's interesting. The I think as being quants, and like kind of the group of us, you kind of see the world in terms of numbers and systems and algorithms, and so there's it in investing. A lot of it is discretionary, or it's very subjective. But sometimes it's almost a challenge saying, "Ooh, how can I make that an algorithm or a quantitative strategy?" So you gotta kind of try that. I mean, it's an example, and it's not quite a strategy, but it's kind of a component. But DCF, it's a very subjective, big spreadsheet, which gets a lot of debate. Are they useful? Are they not? But not really by default. Not really intended to be an algorithm, but I think there are ways that you could do that as an algorithm to find your own fair value.
Yeah.
But yeah. Yes.
So I'm just wondering, in the stuff that you post, you have a lot of very liquid stocks. You know, you got your guts, baby guts, liquid. So why do you do that? Well, obviously slippage, market impact is quite an issue. Why do you focus on that segment?
Really inefficiency. I mean, that's where I mean, if you really want to get outperformance, I mean, you kind of have to try to fish where there's the most opportunity and the most inefficiency. I mean, institutions are there, but maybe not in the concentration that they are with say the big caps. Also, a lot of these stocks are misunderstood. They're not followed that closely. So again, if you can kind of get in, understand their financial statements, which actually aren't that difficult, really. You know, a lot of small caps, they've got relatively simple business models, so they can screen well in portfolio 1 to 2, of course. There's not a lot of noise because there's not a lot of attention. So that's definitely a good aspect of finding those types of stocks. And I mean, if you're, I don't want to say the word lucky, but some of these stocks will grow into much bigger companies. So when they're small and just starting out, they've got a potential long runway to go.
I just wanted to add that, you know, the really good thing of portfolio 1, 2, 3 is, I mean, you can test an idea, right? I mean, you won't get out in the morning and have 20 ideas. Sometimes they just come to by chance, and that's really a good thing. I tested a screen from breakout traders, and he shared his criteria on Twitter, and I took it and I said, okay, you know, he's not trading then systematically, but he screens them, and then he looks basically on technical patterns. And I said, okay, let's just test that. When I put that in portfolio 1, 2, 3, does it have a positive expectancy in the first place? And then his TA comes to it, and then he can do worse off. And I was blown away. I was absolutely blown away. It was like, I don't know, 25% in the first place. 4-week rebalance, right? great back test, and so that's a really good thing. And he had some ideas where I never really thought about. He's looking at average true range, not in a percentage wise, but actually the normal average true range, and that's really nice that you can by chance you get an idea and you can test it, or you can try to replicate, as Ryan said, academic papers, and it goes really fast, and that's really
Yep.
good.
Definitely.
Well,
Definitely.
so Ryan, you go into the places that most people don't want to go to find alpha. What are some things that you won't do though?
I will do. So as a quant, I don't read 10Qs, 10Ks. The beauty of being a quant investor, that you've got all the data in your database. It's there. It's already there free for you to screen and to rank. I don't do DCF. As I mentioned, I mean, there's ways to do it algorithmically, but I don't use that in my criteria. I don't interview management. That's a really popular approach for student investors who deal with small caps and micro caps. And again, the beauty of data is very objective, and you can really see where a company is going through the data. Now I've not interviewed management, but that is still quite subjective. And I think at times it could be misleading. Like if management team is quite good at selling and things like this, could distract from other facts. But I'm not saying that it's not a good strategy, but it's just something that I don't do particularly.
They're usually the best salesman in the world. I mean, your shoe will not tell you anything bad about this or our company. So, I mean, I know also people who do it successfully, but it's very hard to quantify.
Yeah, I mean, some people do it and they reliable, but I mean, I actually tweeted something the other day, and it should be a great, okay, you can be a great business analyst or know your business very well. Yeah. That doesn't necessarily mean that you're a good investor. Like, I mean, that it's two different skill sets, really, with some overlap. But I mean, investing is about assessing different risks. You're always assessing for different opportunities. There's opportunity costs, which you're trying to optimize for. Whereas if you own a business, I mean, you know that business really well, but the environment outside maybe not as well.
And I think within video right now, that's the big question. They're saying, well, the business is continuing or is expected to grow, but is the stock at a good price right now? Well, that's a totally separate question.
Exactly.
And I have to say, getting back to hearing the storytelling and narrative of managers, one of my most embarrassing mistakes, and sadly, I wrote about it even on Seeking Alpha a number of years ago, was I totally got sucked in by the owner of a company. And I was like, oh, this for sure is going to go up 100 times. I believed it. And I ignored the data. I broke every sacred rule that I hold dear. Never again. Because I believe people. They tell me through. I don't have a good filter for that. So now I completely ignore the story. Say anything you want. I'm just going to look at the data.
Sure. Yeah. No. Good move.
Tell us about the 10 times stock research. What is that all about, Ryan?
Yeah, I mean, 10x stocks. I mean, or let's take a step back. So multi-baggers. I mean, it's like the holy grail of investing, finding stocks that are going to grow, have multiples, 5x, 10x, 100x. Very, very popular. Very, very prestigious if you can find them. Being a quant, from time to it's tough to find them. I mean, you have to hold on to them too. But using portfolio 1, 2, 3, you can find criteria that actually have driven many of the 10x stocks in the last 25 years. So yeah, I did a research piece or a series of pieces that looked at the different factors that really drive a lot of 10x stocks. Yeah, I mean, some of them include growth, high growth. I mean, or basically scaling. Like, I mean, to get to such a high return, a business really needs to be able to scale. Sales growth is pretty important. What else? So that's critical. ROIC. It's a really favorite factor for a lot of investors. It's in kind of in academics and textbooks is kind of being like the holy grail of factors. But at least in my research, a high return on invested capital isn't particularly a strong factor. It's more what's the direction of the ROIC? Is it improving? Is it deteriorating? Is it flat? So what a lot of these 10x stocks showed is that when they were starting out in their ascent, they didn't really have a very strong ROIC, but definitely along the way, there was definitely some improvement there. So always a good idea to see how, not just ROIC, but a lot of factors, how they're trending.
Yeah.
Over.
Right. Kind of factor moment.
I agree. I agree 100%. That's, I mean, sometimes you really have company that does look very well, but, you know, as long as the fundamental factors have good momentum.
Yep.
And then, you know, basically, together with price momentum, that can be a good approach. 100%.
For sure.
Let's get into guts. I want to hear about guts.
Right.
On pins and needles to hear about the performance later. Yeah.
Gonna keep you on your toes then. Okay. So let's see if we got a slide here. Okay. Let me see if I can share this though. Here we go. Can you guys see it?
Oh, perfect. Yeah.
Okay. All right. So an important part of investing, whether you're quantitative or discretionary or whatever it is, to really outperform, you really need to have an edge. Like, what sets you apart from everybody else? I mean, everyone says they have an edge, and I mean, it's an edge is difficult to have. I mean, it's difficult to find, it's difficult to maintain, and it's going to be different for everybody. For me, I think of edge in two ways. You have to think differently, and or you have to act differently than everybody else, or at least a majority of people. So thinking differently, I mean, data is very available. It's very accessible now, but how you use the data is totally up to you. I mean, that if you got a very versatile platform, of course, like Portfolio 123, you can find new signals, you can find new interpretations of data to try and find some kind of an analytical edge. And then second of all, you have to act differently or behave differently, whether that means being able to stomach volatility better than others, or hold better than others, or buy before or sell before others. It's all in the actual actions. Being able to buy when the market's down, when everyone else is selling. There's different components which we will get into. But with any edge, like even just literally the edge on a knife, it will wear over time. It will become less useful. So really, it's one of those things that you will keep looking at, keep training, keep improving. So the way I look at an edge is something that I call guts. So it's this looks at both factors, which is the think differently, and then also the mindset, which is the act differently. So for factors, these are pretty much the common factors which I use in most of my strategies. G is for growth, and for micro caps, I mean, growth is critical, and you want to get that sales growth, which will ultimately lead to earnings growth, which then leads to price appreciation. Then also understanding a lot of microcaps are cyclicals. I mean, they're cyclicals. I mean, some will stay cyclicals for their entire life. Some will go on to become the next mega cap, and then some will just stop growing and just go into a decline. So kind of knowing what kind of stock you got on your hand and what kind of growth profile there is can be quite important. The undervalued part, I mean, this is your classics, your classic value investing factors. You want to find stocks that maybe are undervalued, that maybe the market's not giving a very high multiple for. But again, I mean, like anything, and I think as the markets do become more efficient, I mean, this is a double-edged sword, because in a lot of cases, I mean, the market is pretty good at finding what's cheap for a reason. And so especially with micro caps, which naturally have a low valuation, you just want to look carefully at why it's undervalued. But when it's paired with the high growth, that's potentially a good combo. T for timing. This I think is a pretty important part of having an edge. Is, I mean, and again, it's kind of contrarian, because a lot of investors say, "Oh, you can't time the market. Timing, you can't do it." But really, I mean, markets are so dynamic. I mean, time is such a component of markets, and I think trying to take advantage of that is in your best interest. I mean, investing, I mean, it's all about opportunity cost too. I mean, it's great. You found the perfect stock. It's got perfect fundamentals. You get in, you buy it, but it doesn't move for 6, 9, 12 months because no one else knows about it. So sometimes if you can find a stock that's already started to move, call it momentum, call it volume spikes, or some other kind of catalyst that's happening, you're, I think, in a better position. And then finally, sentiment. This is this is what the market is kind of saying, what analysts are saying, what are the trends in kind of the data in analysts reports, ratings, downgrades, upgrades, kind of tracking that for a stock. Again, trying to get it when it's improving is where I like to look. So that's the think part of the edge of guts. But then for behavioral and sort of the act, differently again with guts, G, gumption. This is I guess a synonym for courage. So I mean you can have the best simulation, the best thesis, but if you don't go buy that stock, I mean, it's not going to happen. So really, you have to have the courage to just do it. Similarly, you have to be able to stick to your system when things are rough. So there's kind of an element of courage there, gumption. Uncertainty. I mean, markets are full of uncertainty. It's what's going to happen. What's the geopolitical state of affairs today? What's inflation doing? What's Elon Musk doing? I mean, there's so many things. It's just almost impossible to really get a hold of everything. So I mean, just kind of being comfortable with not having all the information is something to get to. Is something you have to learn, I think. I mean, in some fields, I mean, people are used to having all the information before they make a decision. That's a boss. Investing is not that. Or is not that. Okay, T, trust. So trust can mean a lot of things. It can mean for a quantitative strategy. Okay, you've done all this work. You found a signal in the data. It's strong. It's robust. So and it could go completely against against what everyone else says or what the popular narrative is. But if the data is there, I mean, there's some potential opportunity there. So if you can trust the data, trust your process, that can really provide some edge. And finally, stamina. I mean, stamina is just, there's volatility, which can really wear down on you over time. It's, and it can really cause some people just to say, oh, that's it, I'm out. But of course, as the whole adage goes, once that happens, the market picks up again. So, I mean, just being able to kind of stomach those wild swings and or even just if your strategy is just flat, like it's not doing anything while the market's going up, again, just being able to hold and just wait, and then trust it goes back to the T, then you should be okay.
Ryan, I really love that. I mean, if you're good in designing strategies, obviously the left side is doable, right? Especially with portfolio 1, 2, 3. But when I talk to, my network, and I'm putting myself here, I'm the first to admit it, the behavioral mindset is extremely important. I mean, especially as you said, when volatile time comes, the market pulls back whatever I had this summer, I had my strategy went nowhere for 3 months. While the market was going up, right? I mean, stuff like that happens. It had a very good run from November to March, and then, stocks digest while the market is, blazing, and it was trying to make me nuts. And it's really important that part. It's you have to combine both, and also a lot of people, I think, totally overestimate their risk tolerance, right? So
For sure,
their strategy goes up, whatever, makes 40-50% a year, but I had like 2-3 drawdowns of over 40%, 50%, and the chart looks good, but having the trust, the stamina in the moment where you have drawdown, that's really really important. Yeah, I love it.
The thing that I'm proud, Brian, is the point you brought out about the valuation. Because I actually find for myself, like I'll take a few thousand potential stocks, and the big part is just removing the high risk junk. I don't actually focus on what makes good stock at the beginning, and I'm left with a group of 300 stocks just by removing the junk that has a value component.
right?
They're pretty good. And then from there, I can, the last 25% of my effort is seeing which one of those are better. But I like that because it's true. Cheap can be high risk or it can be under followed, and you gotta somehow determine which category it falls in.
Absolutely, yeah. It's it can be tricky, but yeah, definitely. And I mean, it kind of takes, you almost have to unlearn that, at least for me, because I mean, when I started reading Graham and Buffett, I mean, value is everything. Oh, it's cheap. Okay, that's fantastic. This is the best stock ever. But no, not really. I mean, that's evaluation is what the market thinks. And yeah, as the market becomes more efficient, as mentioned, it's, I think there are less and less of those opportunities, but yeah, you just have to be careful.
Nice. Thank you.
Thank you. Okay. So that's guts. And then we can just, I'm just going to go to some performance here.
Oh, okay. We get the performance. Nice.
So this is basically my major strategies, which I've been tracking since I've been live, from January 2020. Other than chill liquid, that's relatively new, but these, okay, basically got two major strategy is the guts Y and then the guts J. And they have slightly different factors, different weights. Sometimes the similar stocks, but they're both small micro caps. Both have one US and one CAD strategy each. So, knock on wood, or just getting positioned. So, I find 20 to 25 stocks is kind of the sweet spot. Anything more than that, you start to dilute, or you start to lose the effectiveness of the factors. And then anything smaller than that, you really get quite concentrated, which was actually where I got burned the first time being a quant. Is I super optimized, did fantastic for 6 months, and then everything just blew up. So it's I learned my lesson, and this is kind of where my comfort zone is. I guess with portfolio 123, or at least my strategies in particular, you can see here my average hold only times anywhere from around 3 to 6 months. Of course, there's some that are quite longer, shorter, but I'm definitely not a buy and hold investor, but I'm definitely not a day trader either. So somewhere in between, I'm sure that's the same with you guys too. So that's something that's part of the strategy. And then it's not listed on here, but the turnover is about 150 to 250% per year. So again, that I try and keep it below 300, but sometimes it will go higher. So yeah, I've been I guess you could say fortunate enough to have these returns since 2020. I guess 40, 50% with some variation of course.
So when are you retiring, Ryan?
Working on it. Yeah.
Wow, that's impressive. Wow.
Yeah, very impressive. And I really love the Canadian systems. I mean, that's really great that obviously the market is a little smaller, and it's nice that you can choose out that kind of performance number. Is great.
Yeah, no, thanks, Andreas. And I mean, it does vary, of course. I mean, 2023 was a bit tough for the Canadian markets. Well, I mean, it's still pretty good, but I guess historically speaking, it wasn't so hot. But then again, they've almost done a reversal. We're into mid 30s year to date versus the TSX, versus the TSX around 17.
So Ryan, I'll be honest, you're gonna get no sympathy if you're complaining about 15% your return being nobody's gonna shed a tear.
One, sorry. Yeah, that knowledge.
Yeah, nice.
Yeah. Yeah. No, thank you. It's but I mean, I just want to stress though that I mean I made a lot of mistakes leading up to this. As I said, I got into portfolio industry. I think I first became a member in 2016, and then 2017, 2018, I found some strategies, which I spent some time on, but in hindsight, they were quite over optimized, very concentrated, 5 positions. Did well, as I said, for 6 months or so, or maybe even a year, but then it just fell apart, and it just completely. I mean, the regime of the market changed, and the strategy was not aligned. And again, with 5 stocks, I mean, man, you can really feel some pain that way. So there was kind of a lot of, I guess, learnings here and mistakes and a learning curve.
Yeah.
And I mean, still continuing to learn. And I mean, just as an example for the small caps. I mean, this strategy in particular has done well. It just is suddenly just frozen for this year. So the question I'm asking myself for the last 6 months is this strategy broken? Is it just a lull? Do I need to refine my factors? Things like this. So that this is kind of things you have to look at when you're dealing with quantitative strategies. I mean, they won't work all the time. Yeah. And then the question is it temporary, or is it something more more structural.
So I have to ask, Brian, do you manage other people's money at all, or do you have a service where you can kind of guide people a little bit?
I don't, or at least not yet. As I said, I've got. I mean, I have my other gig, but definitely it's something that I'd like to consider probably in the next couple of years or sooner. Yeah, love to. Yeah, or I mean, the idea of having a fund. I mean, I've considered that. But yeah, I think maybe the next year or two.
Coming back to the, to the optimization part, I really think we should do a video, us three, doing about, how not to over optimize the systems. When I talk to clients and they show me their models, sometimes they look very, very well. And then I look in the buy and sell rules and I see like 25, 30 buy and sell rules. And, that's just not going to work, right? It's just, a system needs degrees of freedom. And, let's do a video about that because, a lot of people get hurt. But when I do strategies and I go with certain design rules, they work. They, at least in the expectancy of the capital curve, I would say that 95% of the stuff that I'm designing, I hold them and I have like, I don't know, 300, 400 strategies. And obviously I can't trade them all, but they hold up pretty well. They can have a year where it goes sideways or whatever, small caps are not in vogue or stuff like that. But let's do a video about that.
Yeah, sure.
We generate clients.
Yeah.
And I made the same mistake in 2019, right? Actually knowing design rules, I thought, okay, you can beat them. And no, you can't. Build a list with 15 altogether, 15 buy and sell rules. And it still wasn't too bad. It didn't fall apart totally. But the capital curve was not tradable at all. It was so volatile. No, let's do that. Yeah.
That's the thing, right? Yeah, definitely. No, it sounds like a great idea, Andreas.
Yeah.
Definitely. Yeah, for sure. You're sharing it, bro.
Now let's suss out the secret sauce from you, Ryan. Let's
Trip time.
Show us some capital curves. Yeah, we want to see things here.
It's been read out.
So this is an output from Portfolio 3. This is a wonderful option. You can actually do a professional link cut sheet from your strategies. So this is the Gutsy strategy from Canada. That's number 2 there. Yeah, we don't have to go through all this. Showed solid performance from over the various years here. My turnover there is 165%.
Wow, that's very good.
Teasing. Thanks. So this is the Gutsy Canada strategy. That's number 2 here. Hopefully you can still see this chart. So it's a nice function of portfolio 1 to 3 for any strategy. You can create a very nice cut sheet very easily, showing you some very key stats if you're looking to showcase your strategy or share some characteristics with others. As I mentioned, this is guts. So looking for growth, undervalued, timed, and sentiment. 165% turnover. Maybe just a side note. So dividend investing is a very popular approach to investing. That's really not a factor for the types of stocks that I look for. Maybe I'm looking for stocks. Well, let me back up. It's not a factor at all. So it's not that I don't look for stocks that have dividends. It just turns out that a lot of stocks that the strategy picks don't have a dividend or it's quite low. I think chances are when you've got high yielding stocks, they may be past their main growth phase anyway. So just a side note there. Yeah, and it means the win rate's about 53%, losing 47. I mean, in quantitative strategies, I mean, this is common. I mean, as long as you're more than 50%, I mean, you can't go with the expectation that you're going to have 80, 90%. That's just really not reality. But
No.
yeah, but what is important is the return for those winners. So if your strategy is finding and it's got a decent win rate, but high winners, then you get. No, kidding.
Real equity ratio of 2.0. That shows very, very hard to get. And obviously, it's not. We're not looking at a back test. We're looking at all the sample.
Correct.
So that's
Correct.
that's pretty cool.
Yeah.
Very, very good strategy. Good work.
No, thanks. Thank you. Yeah, there's the equity curve. So it started, and again, okay. So this is the same strategy, equity curve. Started January 2020, of course, just before, as we all know, COVID. So,
I mean, look at 2022. That's bombastic. That's super great. Did it pick a lot of oil stock in 2022, or
that's exactly it. It's exactly it.
perfect?
That was pretty much the only only sector really that had some momentum to it in the strategy.
Yeah.
And of course, this is Canadian as well. So where there's concentration of energy to begin with. So that's really helped. Drawdowns here. I mean, I generally don't, and I guess that's another factor. So designing a strategy, I mean, you can optimize for different things, absolute return. Sorry guys, there's some background noise. Can you
No problem. Yeah, you got the plane coming.
Right?
You have the plane coming. They're picking up.
So where do we? Okay, so the drawn out. Okay, so when you're designing a strategy, you can optimize for different factors. They could be absolute return, risk-adjusted return, drawdown. I mean, every investor is different. They've got different risk tolerance, or they could be a different part of their life. They could be looking to just accumulate capital or preserve capital. So for me, drawdown isn't so weak. It's not easy, but it's not a factor that I look to optimize really. But that being said, I guess my lowest drawdown here was just during COVID, about minus 30%, which I think most people felt. And then again in 2022, excuse me. And then it's kind of been consistent the last couple of years.
Yeah, but again, I really love the Kepler curve. You know, I use a lot of statistics, the measuring the Kepler curve, but I think the best thing you can do is look at the Kepler curve, and you need to see the alpha, but I think you also need the correlation to the overall market. If I see Kepler curves that have absolutely no correlations to the market, and obviously we're doing your trend following on momentum and on fundamental factors, it's basically trend following, right?
Right.
And that's how it to look like. It needs to correlation to the overall market. Otherwise, it would not be robust. So I think the Kepler curve looks very, very good. Yeah.
Great. No, thanks. It's yeah, this one's been good for sure. That are showing some activity, and just kind of by coincidence, they've all 3x or 200%, but in very different time frames. So the ZomD, that's part of the chill liquid strategy. Yeah, it's a Canadian stock. In about 97 days, it's hit 200%. At the same time, tailored devices, TD, and US, it's 600 days and about the same return. It was higher, I mean, it's been losing some ground as on earnings, you probably know. And then similar DRX, that's on the TSX, 400 days, 200%. So I mean, you can really, I mean, small caps are really funny. I mean, what the first one is ideal. I mean, it's, again, to me, it's all about minimizing opportunity costs. I mean, the longer you're waiting, the longer you're holding, and nothing's happening, there's chances are there's better stuff out there. So, I mean, this does not happen all the time. Just to be very.
And I also saw on Twitter that you trade Rayo pretty successfully.
Oh,
That was a nice trade. Yeah, I saw it. But right.
yeah, no, that kind of came out of nowhere too. It's been flat for years, and then it just kind of popped.
Yeah,
and the algo picked it up. I recently sold it, actually, but
you sold it much later than me. I think I sold it, I don't know, the 55%.
Oh,
I
yeah?
think you had like 20%, something like that. Yeah.
Well, it all depends, right? There's different factors.
Yeah.
Okay, so I also have a strategy which I call baby guts, which is kind of like I guess my public strategy, which I like to show to people just how portfolio 123 works and how guts works. If you want, we can run through that.
I'd love to hear about it.
Okay. So baby guts. I mean, this is the guts which I discussed, and it's just kind of the baby version. So what are they? So what's the theme here? So we're talking about micro caps that are undervalued but growing. US want to get some liquidity, so 100,000 per day, and of course remove financials, rates, and utilities, which is a common move for many quant strategies. Not all, but definitely these can screen differently than, say, your industrials and techs. Okay, so what factors are we going to use here? So for growth, we want to look at growth in EPS, or earnings per share. Higher the better. U undervalued, so simple low PE. Timing, we'll just use some relative strength. And then sentiments, low short interest. So we've got a ranking system, which is a core to many portfolio 123 strategies is the ranking system, which goes back to the magic formula from Greenblatt. It's basically you're taking all stocks in the universe, ranking them on each criteria, and then finding a composite score. So in this case, as I said, we've got high EPS growth. So this is excluding extraordinary items compared to the previous year quarter. We've got undervalued. So earnings yield, relative strength. I didn't show this, but it's essentially the momentum of the stock. Short interest, or the sentiments is low. And then if we're looking for smaller stocks, then we want to rank low on market cap. So the smaller the market cap, the better.
Just a question there. Do you have a preference between using the short interest ratio versus percent of float? Does it matter much?
I haven't really looked at it, to be honest, Curtis. I mean, I usually use this one, but
I'm going to switch because I use the other one and my performance isn't like yours. So I'm switching today.
Okay. Yeah. Interesting. No, I'll have to experiment with that too, though. So this is the old style of the ranking for portfolio 123. Now it's quite different. But anyway, this is basically for those who aren't familiar with these. Basically, you're ranking the overall performance of each decile. Decile being each bucket of 10% of the stocks over this full time period. So what it's showing is that the highest ranked stocks actually end up with the highest or second highest returns. The second decile or second highest ranked actually have the highest performance. And then what we want to see is this nice slope downwards of the lower the rank, the lower the return. And then, of course, this bar on the left is our benchmark, which is the Russell 2000. So that's a full time period, and I guess maybe just worth noting that this is over this type of pattern over a long period. I mean, it's great to see, but it is a very long period. I mean, if you broke this down into even 5-year periods, this would look very different. Which is important to consider when you're looking at strategies. Is long-term performance is great, but it can hide a lot of volatility. But nonetheless, that's a good signal. Here's the baby guts universe with all the portfolio industry language here and coding. So it just removes REITs, utilities, financials. There's our liquidity rule. We just got the one flow industry and one master LLP companies.
So you've given us all the rules that we can copy it. Do you make this available to people? Like, is a public screen or no?
Yep. It's completely public.
Oh.
Yep. I can send the link after. Okay. So this is a back test from 1999 up until about a year ago. Basically, turns out return about 20%, 20% CAGR. What else can we say? So the turnover is good, 230%. Overall winners is a bit on the low side, 47% is less than 50, but still overall has managed to do well. Excuse me. And this is a common output for portfolio 23 for performance. You can see the last 12 months, of course, by year. So look at this strategy. Anything black in the excess means that it beat the market or beat the benchmark. So it did struggle in 2008, 2011, and then 2016, 2019 had a really rough run, actually. But that's but I mean, at least to convey the basics of quantity and then guts. I mean, 4 factors just for perspective. I mean, my strategies have anywhere from 30 to 50 factors in the ranking system. So I mean, definitely there's areas to improve here, and I mean, add and edit, and certainly users are welcome to take this and erode to make it their own. Okay, so that's baby guts.
So what tips do you have, Ryan, for people starting out with Portfolio 1, 2, 3, or even just starting out with investing? They read a book that says you're going to make $1 million a year with one simple formula. What's your suggestion for them?
I think really you just need to do it. You need to start. Like get in the market and put some money in the market and just see how things actually work. I mean, it's one thing to read a book, and unfortunately, there's a lot of investing books, a lot of recommendations. There's lists of books that you must read, and they're great. They really are. But your real education will come when you're actually in the market. Especially when you're starting out. One of the key items is to really get to know yourself, your investing personality, your risk or your tolerance for risk, what types of stocks you like, what interests you, what gets you excited. Like there's so many ways to invest. I mean, some may interest you. I mean, you may want to be up on every single bit of information on NVIDIA, or you may want to find the most obscure stock that no one knows about. And yeah, it's all up to you. And you don't really know that until you get into it. I think another thing that's a bit maybe contrarian here is that you actually want to lose money when you're starting, meaning you just make mistakes, learn. I mean, when your capital is relatively small, it's not going to change your life really, but it's basically tuition for you to learn. Again, how markets work, and again, what makes you tick. And then, of course, you'll find your way, and then you want to try and avoid losing money as you accumulate.
Yeah.
Okay. So can you tell us a little bit about how we can follow you?
Sure.
Yeah.
I'm on X or Twitter X, just r_Telford_invest. You can also find me at Seeking Alpha. Find my name, Brian Telford. I must admit I've been a bit slow in there the last year or so, but I did a few articles in the works. And then, of course, if you're on Portfolio 123, just find my R Telford handle. I'd be happy to chat in the forums.
Awesome. And what about investing in your fund? Can we expect that in about 6 months?
Working on it.
Okay. Nice. Is there anything else, Andres, that you want to ask them about, drum out on?
No, I think we covered a lot of stuff, and what I really like is that, right, you were sharing actually, you know, a jumpstart for people going to Portfolio 123, and they can basically see what you have built and then build on that and progress. I think, you know, the base strategy you laid out just 5 minutes ago, that's a really good start for a lot of people coming to Portfolio 123 and using that. Perfect.
Fun.
I love that you have actual auto sample results, live results to show us. And I love how you actually show us sort of a dummy down or a more simplistic design of what you did. Obviously, you can't give away the 45% return secret, or that would diminish your returns, but you actually show us where to start with actual ranks and rules. So thank you, Ryan. This was hugely informative for both me and I'm sure everyone that's might be watching this.
Thank you. My pleasure.
Thank you.